equity. How does a business create value or equity? Reviewing the balance sheet formula, we can see that assets minus liabilities equals equity. This may suggest to increase assets. But how does a business increase the value of an asset? Most assets lose value over time, like furniture and computers. Real estate may or may not increase in value over time. Buying a new asset will not increase equity. This is because if a business buys a new asset, then cash may be reduced to pay for the new asset. In this case, the equity has not changed, as shown in this table. We start with a cash of $8,000 and a bank loan of $7,000. $8,000 minus $7,000 leaves us with $1,000 in equity. We then purchase a computer with cash, so our cash is reduced from $8,000 to $6,000 to pay $2,000 for the computer, but we now own a computer that's valued at $2,000 because it's brand new. So our total assets is still $8,000, same as it was before. Our bank loan has not changed at $7,000, and our equity remains the same at $1,000. So our balance sheet has changed slightly to represent that we now own a computer valued at $2,000, but with the reduction of the cash used to pay for the computer, the total value as represented by the balance sheet has not changed. Now, what if the business buys the computer using a credit card? In this case, the credit card balance will appear as a liability, and again, the equity does not change, as shown in this table. So notice prior to purchasing the computer, we have $8,000 in cash and $7,000 bank loan for a total equity of $1,000. We then purchase the computer not with cash, so the cash stays the same at $8,000, but the computer is valued at $2,000. So we now have assets of $10,000. So notice our assets have actually gone up by $2,000 now, from $8,000 to $10,000. But similarly, our liabilities have also increased. Our bank loan has stayed the same at $7,000, but we paid for that computer on a credit card, which is money that we're going to have to pay at some time in the near future. So we owe $2,000 on a credit card, which is a liability. So our liabilities have also gone up by $2,000 for a total of $9,000. So 10,000 assets minus 9,000 in liabilities equals 1,000 in equity. Our equity has not changed with the purchase of that computer or that asset, whether it was purchased with cash or credit. Buying, renting, or leasing assets does not increase the value or equity of a business. It's what the business does with those assets that may contribute to increasing equity. For example, buying a new computer may allow you to serve more customers, to sell more product, and generate more revenue and profit. This additional profit increases equity. Buying the computer did not directly increase equity, but how it was used did. Again, reviewing the balance sheet formula, assets minus liabilities equals equity. This may suggest that decreasing liabilities will increase equity. But decreasing a liability normally means using an asset like cash. For example, you can pay off a $7,000 bank loan to eliminate the liability, but if you use cash to pay the loan, then your asset will also decrease, as shown in this table. We start with cash of $8,000 and a bank loan of $7,000 that we owe for a total equity of $1,000. But we decide to pay off our bank loan of $7,000 and we use our cash to do so. So our bank loan is now gone, we have no liabilities, but our cash is reduced by the $7,000 we used to pay off the loan. So cash is now $1,000. So our total equity is back to $1,000. It has not changed. It's still $1,000. BusinessXP is the fastest and most inspiring training ever invented for future business leaders and entrepreneurs. Discover game-based experiential learning at business-xp.com.